What the heck is crypto arbitrage? Hey everyone! Have you ever wondered how some traders seem to make money in crypto markets regardless of whether prices are going up or down? Today we're diving deep into one of the most fascinating and potentially profitable strategies in cryptocurrency trading, crypto arbitrage. But first, let's start with the basics. What exactly is arbitrage? Think of it like this. Imagine you're browsing online and you find the latest smartphone model selling for $800 on one website. But when you check another major retailer's website, the exact same phone is priced at $900. If you could buy the phone from the first website and immediately sell it on the second platform, you'd make $100 profit per phone. That's arbitrage in its simplest form, profiting from price differences of the same item in different marketplaces. Now, crypto arbitrage works on the exact same principle, but instead of apples, we're dealing with digital currencies like Bitcoin, Ethereum, or any other cryptocurrency. Crypto arbitrage exploits price inefficiencies in global markets, as crypto markets often take some time to synchronize prices across exchanges, creating temporary opportunities. In today's video, we'll break down everything you need to know about crypto arbitrage trading, from the different types to real-world examples, and most importantly, how you can potentially use this strategy yourself. So grab a notebook because we're about to uncover one of the crypto world's best-kept secrets. Now let's talk about the reality of cryptocurrency trading. If you've been in the crypto space for any amount of time, you know that price volatility can be both a blessing and a curse. 1 minute Bitcoin is up 10%, the next it's down 15%. This constant fluctuation creates a major challenge for most traders. Traditional trading requires you to predict which direction prices will move. Will Bitcoin go up or down? Will Ethereum break through that resistance level? It's essentially educated guessing, and even the most experienced traders get it wrong sometimes. This uncertainty keeps many people away from crypto trading altogether. But here's where crypto arbitrage becomes incredibly interesting. Unlike speculative trading, arbitrage profits from existing price gaps rather than guessing future price swings. You don't need to predict whether Bitcoin will hit $100,000 or crash to $20,000. You simply need to identify where the same cryptocurrency is trading at different prices at the same moment. The challenge, however, is that these price differences don't last long. In traditional markets, arbitrage opportunities might exist for minutes or even hours. In crypto markets, we're often talking about seconds or even milliseconds. With competition speeding up the price convergence, finding opportunities is possible, but it takes a lot of time and unwavering attention from a retail trader. Another significant challenge is the technical complexity. You need accounts on multiple exchanges, sufficient funds available on each platform, and the ability to execute trades quickly. Many beginners feel overwhelmed by these requirements, which is why many traders stick to simple buy and hold strategies instead of exploring arbitrage opportunities. Let's dive into how crypto arbitrage actually works. There are several different types, but I'll focus on the two main categories that beginners can understand and potentially implement. Spatial arbitrage, cross-exchange arbitrage. This is the most straightforward type of crypto arbitrage. Bitcoin might be priced higher on an Asian exchange than on a US exchange. Spatial arbitrage bots spot these regional gaps and buy and sell accordingly to pocket the difference. Let me give you a simple example. If Bitcoin trades at $45,000 on one major exchange and $45,300 on another exchange, traders can execute a quick, risk-free profit of $300 minus trading fees per Bitcoin. The basic steps for spatial arbitrage are: monitor prices across multiple exchanges simultaneously, identify significant price differences for the same cryptocurrency, buy the cryptocurrency on the exchange where it's cheaper, sell the same amount on the exchange where it's more expensive, profit from the price difference minus trading fees and transfer costs, temporal arbitrage. This type focuses on price differences over time rather than across different platforms. It's more complex but can be very profitable. Temporal arbitrage involves taking advantage of predictable price movements or patterns within the same exchange. Triangular arbitrage. This strategy involves three different cryptocurrencies and exploits price discrepancies in their exchange rates. For example, you might trade Bitcoin for Ethereum, then Ethereum for Litecoin, and finally Litecoin back to Bitcoin, ending up with more Bitcoin than you started with. Here's a simplified example. Exchange 2500 LTC back to BTC, 2500 LTC asterisk 0.004 BTC equals sign 10 BTC at the LTC BTC rate. This shows how traders can cycle through different cryptocurrencies to generate profit. The technology behind modern arbitrage. Automation is the only viable way to engage in crypto arbitrage in 2025. Manual arbitrage is nearly impossible due to the speed required. Most successful arbitrage traders use specialized software or bots that can monitor hundreds of cryptocurrency pairs across dozens of exchanges simultaneously, calculate potential profits accounting for all fees and transfer times, execute trades automatically when profitable opportunities arise, manage risk by setting stop losses and position limits. Key requirements for success. To be successful in crypto arbitrage, you need several things in place. Multiple exchange accounts. You'll need verified accounts on several major exchanges with completed KYC verification, sufficient capital. You need funds available on multiple exchanges to execute trades quickly. Fast internet connection. Speed is crucial in arbitrage trading. Understanding of fees, trading fees, withdrawal fees, and network fees can eat into profits. Risk management. Despite being considered low risk, arbitrage still involves potential losses. Now let me share a real-world example that perfectly illustrates the potential of crypto arbitrage. This example is based on typical market conditions we've seen in 2025. During a period of high market volatility in early 2025, a trader noticed that Ethereum was trading at significantly different prices across major exchanges. On one exchange, ETH was priced at $3,200, while on another popular platform, it was trading at $3,280. That's an $80 difference per Ethereum. Here's how the successful arbitrage trade played out. The setup. The trader had $10,000 available on the first exchange. They had equivalent funds in stablecoins on the second exchange. Both exchanges had sufficient liquidity for the trade size, the execution. Bought 3.125 ETH at $3,200 each, total $10,000, simultaneously sold 3.125 ETH at $3,280 each on the second exchange, gross profit $250, 3.125 x $80. After accounting for trading fees, typically 0.1% per trade, approximately $230 net profit. The result, in less than 2 minutes, this trader made $230 with minimal risk. That's a 2.3% return on their $10,000 investment in just 2 minutes. If they could execute similar trades just once per day, that would translate to significant annual returns. What made this trade successful? The key strategies that made this arbitrage opportunity successful were preparation. The trader had pre-funded accounts on both exchanges and completed all necessary verifications. Speed. They acted quickly when the opportunity arose. Risk calculation. They properly calculated all fees before executing the trade. Market awareness. They understood that high volatility periods often create the best arbitrage opportunities. The reality check. While this example shows the potential of crypto arbitrage, it's important to understand that in 2025, crypto arbitrage will not disappear but will continue to bring profits. But it requires increasingly sophisticated approaches. Overall, arbitrage will remain a viable strategy in 2025, but it will require more technical skills to make a steady income. The most successful arbitrage traders today use automated systems and advanced APIs to identify and execute trades faster than human traders ever could. Some traders have reported consistent monthly returns of 5 to 15% using arbitrage strategies, though these results require significant time investment, technical knowledge, and often substantial starting capital. Let's recap what we've learned about crypto arbitrage today. Crypto arbitrage is a trading strategy that profits from price differences of the same cryptocurrency across different exchanges or at different times. Unlike traditional trading that requires market prediction, arbitrage focuses on exploiting existing price inefficiencies. The main types we discussed are spatial arbitrage, which takes advantage of price differences across exchanges, temporal arbitrage, which exploits price changes over time, and triangular arbitrage, which uses multiple currency pairs to generate profit. The key advantages of crypto arbitrage include its relatively low risk compared to speculative trading, the fact that it doesn't require predicting market direction, and its potential for consistent profits regardless of overall market trends. In 2025, with the crypto market more dynamic than ever, arbitrage trading remains one of the smartest ways to earn consistent profits. However, crypto arbitrage also comes with challenges. These include the need for technical expertise, significant time investment for manual trading, competition from automated systems, and the requirement for substantial capital to make meaningful profits. Additionally, fees and transfer times can significantly impact profitability. The most important takeaway is that successful crypto arbitrage in 2025 requires preparation, speed, and often automation. Successful arbitrage requires quick action, so set up accounts on all relevant exchanges in advance. Whether you choose to pursue arbitrage manually or through automated systems, understanding the fundamentals we've covered today is essential. Remember, while crypto arbitrage can be profitable, it's not a get-rich-quick scheme. It requires dedication, continuous learning, and proper risk management. Start small, learn the ropes, and gradually scale up as you gain experience and confidence. I hope this deep dive into crypto arbitrage has been helpful and enlightening. Understanding arbitrage opportunities can give you a significant edge in cryptocurrency trading, whether you're a complete beginner or someone looking to diversify your trading strategies. Now, I want to hear from you. Have you ever tried crypto arbitrage trading? Drop a comment below and share your experiences, both the successes and the challenges you've faced. If you're new to arbitrage, what questions do you have? I read every comment and often create follow-up videos based on your questions and suggestions. If you found this video valuable, please give it a thumbs up. It really helps the channel grow and reach more people who can benefit from this information. And don't forget to subscribe and hit that notification bell so you never miss our latest trading insights and cryptocurrency analysis. For those ready to dive deeper into cryptocurrency trading strategies, check out our playlist. Finance Inspector got you covered. Remember, the cryptocurrency market never sleeps, and neither do the arbitrage opportunities. Stay informed, stay prepared, and most importantly, never invest more than you can afford to lose. Thanks for watching, and I'll see you in the next video. Until then, happy trading.